Well, turning then to Australia, when I was here 2 years ago, I noted that we could not know how much of the rise in the terms of trade was permanent, and that there was therefore a case to save a good proportion of the additional income until we did have a sense of how permanent it was. Now, in a manner of speaking, we've kind of done that, actually, as a country. Whether that was our intention or not, that's sort of been the outcome. The marked rise in the saving rate of households that happened in 2008 and 9 has remained. Corporations have increased their saving and run down their leverage. Not that leverage was excessive, really, other than in a few celebrated instances, but corporations have been conservative. Admittedly, government savings been lower for counter-cyclical reasons, but that too is now scheduled to rise. And for the nation as a whole, the fact that the current account deficit has been lower on average in the past 5 years than it was in the preceding 20 years, at the same time as the share of business investment in GDP has been exceptionally high, that tells you that national saving has actually gone up. In fact, national saving has been in recent years at its highest share of national income since the late 1980s. That change can, I think, in one sense be seen as a sensible response to an unusually high level of the terms of trade while you're trying to work out how permanent that income is. Something else has also been at work, though, in household behaviour, and I've talked about this on a number of occasions before, but it is worth repeating because it is, I think, fundamental to understanding the current economic situation. After a period, quite a lengthy period, in which high levels of confidence, macroeconomic stability, easy availability of credit, and rising asset values saw Australians borrow more and save less, in the past 5 years they've been going back the other way. They've been borrowing less and saving more. That is, they've changed their behaviour on spending, saving and borrowing back towards what used to once be thought of as normal. Now, that really had nothing to do with the resources boom, but it's had important implications for key business sectors. Think about financial institutions. They're now finding that the normal rate of credit growth is a single-digit number, not a double-digit one, as it had been for quite a long time. Businesses which, in the earlier period of optimism, derived earnings from high rates of turnover in asset markets, think about real estate agents or stockbrokers, face challenges now that turnover is much lower. The retail sector, as we keep hearing, faces different consumers. It isn't actually that the consumers have no money to spend, nor is it, frankly, that their confidence is that low, nor that their saving rate is that high. We have these measures of confidence back to the mid-1970s. They're at about their average level at the moment. The household saving rate shown here, well, 10% is actually not that high in comparison to much of the history. This is the history for the current national accounts, which go back to 1960. The really high saving rates were in the 60s and 70s. To be sure, confidence was unusually strong for an unusually long time in the pre-crisis period, and saving was very low. As you can see here, it fell more or less to zero at one point. But folks, that was unusual, and I don't think that behaviour will come back. In addition to that, consumers are much more knowledgeable now, as a result of information technology, about prices. And they have at their disposal ways of responding to that knowledge that a decade ago they didn't have. You know, the prices, they're all on here, and I can order them on here. These changes are putting pressure on retail business models, and I think that is going right back up through the value chain to wholesaling, distribution, and retail property. And that's one of the things that we see, resulting from a combination of changed household behaviour, back to much more normal behaviour historically, and of course the high exchange rate. and information technology all combining. Given that that change to household behaviour was surely inevitable, it isn't normal to save nothing from income. Sooner or later, saving was going to rise again. Given that that was inevitable, the income boost we've had from the terms of trade arrived, I would say, at a rather fortuitous time. It helped to accommodate a rise in household saving and a slowdown in the build-up of debt in a fairly benign fashion. We can also see that the weakness of some other parts of private spending and our openness to imports and a high exchange rate has also meant that a very large investment, pickup in mining investment that I showed earlier, has been accommodated without overheating the economy overall. That's actually pretty unusual in the history of these things. As it was, real private final demand in Australia last year, 2011-12, rose by 6%. That is way above trend and way above the economy's potential to grow its supply capability, which is more like 3 point something. But now the peak in the investment boom is coming into view. And so the question naturally arises as to how will the balance between the various types of demand in the economy unfold? Mining investment will contribute less to growth this fiscal year than last, and then less again next year. Going in the other direction, it's likely that exports of resources in volume terms will start to pick up as the new capacity is used. That will show up as GDP growth, though it might be predominantly reflected as higher measured productivity rather than generating a large volume of extra employment. Question then will be whether or what happens to other areas of demand. Well, indebted households have made some progress in reducing their debt burdens. At some point, that may be expected to lead to those households feeling a little more inclined to spend. I think that's right. But in addition, a complex interaction of factors which would include asset values not being as high as they were, and expectations or uncertainties about job security, those sorts of things also will be at work in ways which are not amenable to accurate short-term forecasting. So the assumption we're making basically is that consumption will continue to grow roughly in line with income, which it's been doing for the past year or two. Public demand, of course, is scheduled to be subdued because governments are trying to put budget positions back to surplus in line with their medium-term commitments. The outlook for business investment spending apart from the resource sector, in all frankness, according to the best leading indicators we have, is pretty subdued right now. Now, as a cyclical phenomenon, history is that that sort of investment is usually slow to turn. That's been the case in many cycles, and this one looks like it will be no exception. The exchange rate may have also some role to play in helping the needed rebalancing. While it is not surprising that the Australian dollar has been very strong over recent years given the terms of trade event we've had, it is surprising that it hasn't declined much, at least so far, given that the terms of trade have peaked more than a year ago. Of course, a lower exchange rate, if that happened, would need to be accompanied by a pace of growth of domestic unit costs below what we've seen for much of the past 5 years in order to maintain low inflation, which of course it is our very firm intention to do. One area of stronger potential demand growth that we might see is dwelling investment, which has been unusually weak. I'm not sure actually that the degree of that weakness has been satisfactorily explained. Various explanations have been put forward, ranging from interest rates were too high, house prices were falling, zoning restrictions, planning delays, construction costs, lack of confidence. All these have featured in the various explanations that have been put forward. At present, though, at least some of the preconditions one might expect to be needed for higher construction seem to be coming into place. Interest rates have declined, dwelling prices appear to have stopped falling, rental yields have risen, so the equation for investors is improving, and the availability of tradespeople has improved. And we have seen a rise in approvals to build. It's true that much of that's been in the very variable, volatile, multi-unit sector, but actually much more of the action is in that sector these days normally. It's harder to distill the trend as a result, but there is actually evidence of a turning point, albeit a belated one. Well, will the net effect of these development will the net effect of all this be that aggregate demand rises roughly in line with the economy's supply capacity over the next couple of years, or will a gap between the two emerge? Well, that's really the question that the Reserve Bank seeks to answer every time we sit down to decide monetary policy. At the most recent meeting, as the minutes released today show, the board felt that further easing might be required over time. The board was also conscious, though, that a significant easing of policy had already been put in place over the past year, and the effects of that are still coming through and will be for a while. In addition, the latest inflation data, while not in themselves a major problem, were higher than expected, and the gloom in the global economy has lifted a bit, at least for the moment. So it seemed to the board prudent, given all that, to sit still for the time being. Looking ahead, the question we'll be asking is whether the current settings will appropriately foster conditions that will be consistent with our objectives, that is, sustainable growth and inflation at 2 to 3% over time. Over the long run, though, the bigger question, the really big question for all of us here and for the business community and the policy-making community more broadly, isn't the monthly interest rate decision, as fun as it might be to speculate about that. The really big question is, what is the sustainable rate of growth of the economy and how might we increase that? That's really the question. Beyond its role of preserving the value of money, monetary policy really can't do much about the sustainable rate of growth of the economy. It is what it is, and we take it as a given, and other policies have to be devoted to increasing that sustainable growth rate if that's what we want to do. Moreover, the initial contribution of rising mineral prices to our standard of living has now run its course, as I've said earlier. Certainly, a larger capital stock in the resources sector, which we are going to have for a long time, will make its contribution to the level of our living standards for many years, to the extent that Australians either own some of that capital, work with it, or can tax some of the proceeds. But the biggest contribution to growing our living standards will be what it's always been, other than in periods of exceptional luck, and they don't last long, and that is productivity performance. At the last dinner that I had here 2 years ago, I said that while our terms of trade are handed to us, for better or worse, by international relative prices, the efficiency with which we work is a variable we can actually do something about. Now, for some years there's been evidence of a slowdown in productivity growth. As shown here, this is the level of productivity. It's output per hour worked in the market sector, and I've stripped out mining and utilities because there are some very unusual things happening there. But it's hard to avoid the conclusion that for 7 or 8 years the trend pace of growth is considerably lower than it had been in the decade prior to that. If you look carefully, right at the end, in the last observation in 2011-12, there's a lift in the slope of the blue line. That is to say, productivity growth picked up in the latest year. That's very encouraging. Of course, it's way too soon to conclude that a new, stronger trend is now in place. In the field of measuring productivity, given its potential to be cyclical, variable, and very hard to measure, you need long runs of data to draw conclusions. In my opinion, the accelerated structural change we are seeing in the economy will result in stronger productivity performance. That's my opinion. But the most one could say at present is that the data in the last year are not inconsistent with that hypothesis, but they certainly don't prove it. Now, at this point when talking about productivity, I usually get circumspect, having said that. And the reason is that I know that in an audience like this, people may ask, what can we do to improve productivity performance? And I'm acutely aware that improvement in productivity, if it happens, it's going to be delivered in enterprises. The enterprises that people like you run, and millions more around the country besides. Productivity doesn't pick up simply because the central bank exhorts it so, and it doesn't pick up because of some official pronouncement. It has to be delivered by enterprises, their managements, their boards, their employees, and their technologies over time. As for policy measures, well, at a meeting in Brisbane in the middle of this year, I said, off the cuff in answer to a question, quote, "The Productivity Commission has a long list of things to do. My answer to what we can do about productivity is, go get the lists and do them," unquote. That comment elicited, it's fair to say, a good deal of attention. The chairman of the Productivity Commission was, I'm led to believe, inundated with media demands, can we have the list? And he had to explain that he didn't quite have a list in that form. But very helpfully, Gary Banks has in fact kindly drawn up a list which he's promulgated in his final speech at the end of a very distinguished tenure as chairman of the Productivity Commission just a few weeks ago. His list is a rather more complete one than anything I could draw up. In fact, it's 3 lists, each under a heading. There's a list of things that affect incentives, there's a list of things that affect capabilities, and there's a list of things that affect flexibility. What I found most striking reading through, and I commend that speech to you if you haven't read it, what was most striking to me was the comment in the conclusion that no single policy offered the secret to success. He's obviously been asked by people, what's the one big thing we could do? And I'm often asked that too. And here was his answer, no single thing is the secret. And to quote, rather, what is needed is an approach to productivity policy that embraces both the drivers and enablers of firm performance, firm level performance, and is consistently applied. That in turn requires policy-making processes that can achieve clarity about problems, reach agreed objectives, and ensure the proper testing of proposed solutions. The beneficial and enduring structural reforms of the 1980s and 1990s are testimony to the value of these policy-making fundamentals. Good process in policy formulation is accordingly the most important thing of all on the to-do list if we are serious about securing Australia's future productivity and the prosperity that depends on it. Well, ladies and gentlemen, it could not have been better expressed. As the mining boom moves from its second to its third phase over the next year or two, the world economy will continue to present its own challenges. Australia will, as always, need to adapt to the changing circumstances. Looking much further ahead to the Asian century, our opportunities are large. But to grasp them, that same adaptability, combined with a clear focus and steadiness of purpose, will be key. We have to produce our sought-after prosperity, it won't just come to us. All of us have our role to play, and I'm very pleased to see that CEDA in particular has a productivity program. I think CEDA as an organisation has a role to play. All of the enterprises represented here have a role to play. The policy-making community has its role to play. And I wish you all great success in playing that role. Thank you for your attention and compliments of the season. Thank you.